everyone, welcome to the next installment of Charts and Perspective, where we use charts to dive into the world of economics and financial markets. I'm Jennifer Nash, an economic and market research analyst for TMX VettaFi. There's been a lot of market movement over the past several months, and in March, the S&P finished with a monthly loss of 5.8%, its largest decline since December 2022. But where does that line up when we zoom out our timeline? Today, we're going to answer that by looking at the market's overall valuation using 4 indicators that I update monthly. The 4 market valuation methods are the Crestmont PE ratio, the PE10 ratio, the Q ratio, and the relationship of the S&P composite price to a regression trendline. These indicators, and others, help gauge whether the market is over, under, or fairly valued compared to historical norms. By analyzing multiple indicators, we get a broader perspective than if we had just relied on a single one. So to simplify comparisons, I've adjusted the 2 PE ratios and the Q ratio to the arithmetic means and the inflation-adjusted S&P composite to its exponential regression. On the vertical axis here, you can see how much each metric deviates from its mean. Now the question we're looking to answer is the market still overvalued? From this chart, the answer is yes. But how overvalued? To answer that, take a look at the table in the upper left-hand corner, where we can see how far each indicator is from its respective mean. In March, the Crestmont PE ratio was 144% above its mean, the PE10 ratio 96% above, the Q ratio 121% above, and the inflation-adjusted S&P composite was 160% above its regression trendline. So that puts the market's overvaluation somewhere in the range of 96 to 160%, depending on the indicator. This is the lowest level since May 2024 and the narrowest spread since August 2024. But with that being said, March's data is still among some of the highest in history. Now let's take the average of these 4 indicators and plot it, along with standard deviations above and below its mean. At the end of March, the average stands at 130%. Nearly 3 standard deviations above its historical mean. While this is the lowest level since June, it still signals an overvalued market. Looking at this chart, you can see that current valuations, based on our average, are higher than they were at the peak of the dot-com bubble and just below the market peak from a few years ago. Now I want to provide an alternative view. Let's adjust the Crestmont PE, the PE10, and the Q ratio to their geometric means, rather than the arithmetic means, the typical average most people think of that we used in the previous 2 charts. With this approach, the overvaluation range shifts slightly higher, between 116% to 170%. Again, plotting the average with standard deviations, we see the latest figure at 148%, 3 standard deviations above its historical mean. The conclusion remains the same. Valuations are still among the highest on record, though not as high as we've seen in recent months. So let's go back to our initial question. Is the market still overvalued? Yes. Although our market valuation indicators have dropped to their lowest levels in 9/10 months, depending on the indicator, we remain at some of the highest valuations on record. To wrap up, I want to point out that these indicators are not short-term market timing tools. Overvaluation and undervaluation can last for years, as we see in these charts. Instead, they're more appropriate for formulating expectations for long-term market performance. That's all for our March 2025 market valuation update. Thank you for tuning in. For more economic and market insights, you can find my content regularly on the Advisor Perspectives website under the AP Chart section.